Hello everyone, welcome to week 9 lecture videos. Today we have 4 learning objectives, and as usual I will be uploading one video on each of these learning objectives. In this learning objective we explain the importance of macroeconomic analysis in equity valuation. When performing security analysis, the process that we are undertaking is trying to estimate some measure of the intrinsic value or fundamental value of a firm. The way we will often do that is by getting some measures of the firm's earning prospects and getting a measure of the firm's future cash flows that we can discount in terms of today's dollars. Now, when we are undertaking security analysis, if we want to get an estimation of the expected future earnings of a firm, it's important for us to understand the context within which a firm exists. The context is both the macroeconomic context, which is the broader environment, but also the specific industry within which the firm exists. By understanding the macroeconomy and the industry, we can come up with better estimations of cash flows. In this analysis, we are applying a top-down approach to security analysis. In the top-down approach, we start getting a view of what we think the economic prospects are going to be through domestic and global economic analysis. Then we have an analysis of the specific industry within which the firm exists and have a view of our thoughts on the prospect of that industry. And finally, move down to undertaking some form of company analysis or valuation with a view to those issues. All valuation models at their heart have a similar feature, is that they tend to measure the price of the share as the present value of future cash flows. So any economic variable that might either affect the cash flows or the discount rate will in turn influence the value of a firm. This is relevant because we know that there are strong links between overall growth in an economy and growth in the company's earnings. Therefore, if we are thinking about a company's future cash flows and its earnings, obviously forecasting the economy is going to be beneficial because it can help us to forecast firm-specific earnings. As an example on the screen, we can see the relationship between percentage changes in nominal GDP and the percentage changes in corporate earnings between 1946 to 2012. We can see a really clear positive relationship. You can see by this upward sloping curve. So there is a positive relationship between the two. Which indicates that as the economy either improves or worsens, that has a strong impact on company earnings. The strength of this relationship is quite high. As you can see, R squared is about 38%. Now, through this relationship, we can see that if we can get a good estimation of how the economy is going to perform, that fits into providing some information of corporate earnings. Now, probably forecasting is notoriously difficult. A famous quote here: forecasting is difficult, especially if it concerns the future, and economic forecasting is particularly difficult. Now, there are several reasons for that. Often we are relying on historical data, or we have incomplete data sets. Often the economy is affected by unexpected shocks. September 11 is a great example of this. It has caused a negative shock to US market, but it was not something that anyone in advance could have predicted. Therefore, when we use historical data, we could have structural changes in the data set, such as September 11 or any other big regulatory changes that have a huge impact on what the economy looks like in future, but can't be predicted through history. Sometimes when we forecast, we blindly rely on trends, which might not be repeated in future. Now, what your forecast should include? Well, despite the fact that forecasting is hard, informed forecast is still better than none. So, as I have got on the screen here, bring right 52% times being right 52% times is still better than a coin toss. And that's what we are seeking to achieve. That means what I am trying to say is if you toss a coin, there will be 50% times head and 50% times there will be tail. Now, if you can forecast and it's 52% times you are correct and 48% times you are wrong, still that's better than none. Well, so we are not expecting that we are going to be right 100% times, but we are going to try to add incremental value to our evaluation process. So what values or what economic indicators do we include in our forecasting model? We should include any estimates of the future economy. It might include real GDP, inflation rate, interest rates, unemployment, and so on. With any economic value, it's important to be able to consider the extent to which those measures relate to the business cycle. We have three different types of indicators here. One is the leading indicators, then coincident indicators, and lagging indicators. The first type of indicator is the leading indicator. The idea of leading indicator is that it tends to rise and fall in advance of the economy. That means these indicators tend to increase or decrease and the economy follows that. This includes stock prices, money supply, and average weekly hours of production workers. When these variables tend to be increasing, we find subsequently or in later periods, the economy tends to improve. So these leading indicators are quite useful as predictive variables. The second type of indicators are coincident indicators. Coincident indicators are indicators that change directly as the economy changes, or you can say they change simultaneously with the economy. So these variables tend to be good at getting measures of the current state of the economy. They include industrial production and manufacturing sales. And last type of indicators are lagging indicators. Lagging indicators tend to follow or lag economic performance. So you can say that these indicators changes following the economy. They include the ratio of trade inventories to sales and the ratio of customers' installment credit outstanding to personal income. While you can argue that lagging indicators have no use in terms of making predictions, lagging indicators tend to be more reliable than leading indicators in terms of actually modeling the economic cycle. Hence, they can also be quite useful in getting a view as to where the economy has been in the past to track cyclical movements. So it might be useful for us to go about engaging in some sort of valuation of business cycle. We will see that the business cycle is linked to industry analysis, and we are going to discuss this industry analysis in our next learning objective. But here we can engage in sector rotation, whereby we can predict the business cycle. One potential investment strategy is to rotate through cyclical and defensive industries based on predictions of that future cycle. For example, if we predict that we are near peak of the business cycle, in those situations, price and interest rate pressure tend to increase, and which can result in increase in commodity prices. And it might be wise to invest in natural resource extraction during this time period. At mining companies, because the price of the resources that they're mining is going to be high during periods of contraction, or when the economy is retracting, we want to invest in defensive industries or in elastic industries such as pharmaceuticals and food. When we are near the trough, when we are near the bottom of business cycles, firms are poised for recovery and firms start to consider expansion by making capital purchases. So often this is a good time to invest in capital goods industries such as equipment and construction. And last of all, during periods of economic expansion, we have high growth. People have a lot of disposable income. So consumer durables and luxury items tend to be the most profitable and the best industry to be investing in this time. So this demonstrates if we can come up with some models and some forecasts of business cycle, we can use that as an investment strategy. Sector rotation across the cycle can also be relevant in terms of some of the investment styles that we have looked at previously in this course. There is evidence that performance of different styles is cyclical. For example, we talked about a small farm effect previously. The small farm investing tends to be highly cyclical. Small farms outperform big farms during economic expansion and peaks, but underperform during contractions and drops. So if you can predict the business cycle, you might be able to identify the periods where it's best to rotate your investment portfolio to one that has greater exposure to small firms. On the other hand, value stocks tend to be just defensive. This means that they display counter-cyclical properties. Value outperforms growth during periods of market downturns, but not during the expansion of peaks. Momentum, as we discussed earlier, tend to be cyclical. Momentum performs better in up markets versus down markets, but momentum significantly underperforms during turning points. So we might be particularly concerned about the peak and the drops because these turning points in the cycle might be those points where momentum suffers big losses. So overall, we can see that it's important for us to consider the macroeconomy as part of the valuation process, and we may be able to form effective investment strategies based on our focus of the economy and the business cycle.